Good afternoon, everyone. This is Rob Barnett, and I want to welcome you to the BI Energy Exchange, where we talk about our research and the latest developments in the market. Oil today is flirting with $75 a barrel. Many calls on the street are for continued momentum. But before we dive deep on the oil market, I want to look at a microcosm within the oil patch, and we put out some interesting research in the last week looking at the election outcome in Peru, and it appears that socialist Pedro Castillo has won the election, and for that I want to bring on Patricio Alvarez to start, but also Grant Spohr, our senior metals and mining analyst, who's joined to offer some thoughts on this as well. So first, over to you, Patricio. Tell us what you think the election potentially means for the oil patch. Who's active there? What kind of changes are you anticipating?
Sure. Thanks, Rob. In terms of who's active in Peru, we've seen a steady exodus of operators from Peru in the past couple of years, and that's primarily due to above-ground risk in the form of local opposition blockades that have affected infrastructure security for the past decade or so. In terms of the impact of the elections, there is only one remaining E&P in Peru called Petrotal, which is London listed, with a very encouraging growth outlook there to nearly double their production next year, contingent on not having any further disruption on the energy infrastructure there. So how does this bode for them? Political risk is high with Pedro Castillo coming into the presidency, albeit we don't expect nationalizations or significant reforms near term. We do see the scope for bigger changes longer term, especially if Castillo goes for a national referendum on the Constitution, which could change things dramatically. In the midterm, we see perhaps a tax overhaul, which will have an outsized impact for oil and probably mining as well. But I'll let Grant go further into that part.
Well, Patricio, before we hand over to Grant, just real quick for us, frame Peru oil market. It's not one we typically think of as a major player. What's their production right now?
So Peru is a relatively small oil producer. It's among the lowest producers in Latin America, with about 100,000 barrels at its peak 2 years ago. Production there is about 50,000 barrels at the moment, and Petrotal is the second largest operator, the second largest producer there, with the rest of the players being Chinese companies. And I also should outline that there is no national oil company with producing assets there. So this election, if it actually it's on a detriment to oil production there, it could actually dilapidate, I think, the oil industry in Peru for good.
Right. Very interesting. Okay, so I think that Peru probably has a much bigger set of stakeholders in the metals and mining space, and I think Grant is well positioned to talk us through that. So Grant, thank you for joining our energy call today, and give us a sense of how you see this election being a catalyst for the metals and mining space.
Sure. So good afternoon, everybody. I'll tackle that question in three parts. I'll just put Peru and particularly its copper production in context. We'll look at some of the companies that are impacted, and then how the dynamics in the copper market could play out. And our view is it's probably positive for medium-term prices. So to put it in context, Peru is the second largest copper producer globally, behind Chile. So it produces just over close to 1.2 million tons of copper, which is around 11% of the global copper market. So it is a very big player. But more importantly, it's a fairly immature region when it comes to mining, and a lot of the growth in terms of copper production, and indeed the replacement of some of the older deposits in places like Chile, which is a much more mature region, needs to come from Peru. So that's just to put it into context. From a study, it's also got the world's second biggest or second largest reserves of copper globally, behind Chile. So it is very, very important. In terms of the companies that are impacted, a lot of companies actually operating in Peru in some shape or form. The ones that are likely to be impacted the most, a bit like what Patricia outlined, are actually the local companies, and they tend to be a little bit smaller and less diversified. So companies like Buenaventura, Hochschild Mining they're actually precious metals producers. They don't actually produce much copper. So depending on what the tax changes exactly are, they are the ones that generate more than 75% of their profit from Peru. On the opposite end of the spectrum, the bigger diversified miners and some of the pure play miners, have sort of 10 to 15% exposure, and by that I mean their EBITDA from Peru. So not insignificant, but certainly something they could manage. The one that sits in the middle is Southern Copper. So it's got about 40% of its EBITDA tied up to Peru. And it's also one of the companies that's got quite a few projects in the area. So that's the sort of challenge that southern Peru will face. And although it's a big copper producer, it's slightly less diversified than some of the others. The interesting aspect will be the copper market. So in the near term, so for this year and next year, the copper market looks to be in quite a big deficit, much less so in 2022, as a lot of the supply that was disrupted during COVID starts to come back. And there are quite a few projects that are being commissioned in that time frame. So let's say in the medium term, if Peru were to change its tax regime, a lot of and one of the big projects is actually in Peru, nothing would change because the company Anglo American is not suddenly going to stop this project. It's going to keep investing because it's invested 3/4 of its capital already. So probably no impact on the supply in the sort of short to medium term. Let's say the 1 to 3 year outlook. However, copper needs, if we assume that electric vehicles and decarbonization reaches a tipping point in the mid-decade, that's when we need quite a bit of copper to come on back onto the market. And really, we need to be kicking that off today. So all the uncertainty that surrounds what Castillo is going to do is just going to defer investment. And we need Peru to really incentivize copper to fill this hole that we're seeing in the copper market mid-decade. So probably no impact on price other than if the market wants to sort of, let's say, assume higher prices in the future in today's price, but certainly in the medium term, it could extend a high price environment out into the middle of the decade. But let me leave it there.
Yeah. Grant, very helpful comments. One of the next topics we're going to be talking about is capital markets days from both Equinor and Orsted. We're seeing a lot of ambitious expectations for more renewable capex, the energy transition. So while we've got you here, just one last thought from you. You did mention the impact that metals mining could have on the sort of the electric vehicle rollout, but broadly, is your sense that the metals and miners are preparing for the kind of world that many of the European energy majors are starting to talk about?
So on the one hand, yes, they are. They're trying to dispose of their thermal coal assets. So that's getting rid of the carbon exposure. Now, it's probably a lot easier for them than the diversified miners because thermal coal makes up a relatively small proportion of their overall earnings. So, the last one was Anglo American. They spun off their coal assets. So yes, they are trying to prepare for that. Their approach in terms of leveraging, let's say, the decarbonization world is to just simply to point to their base metals production, be it nickel or copper. Some of them are moving into slightly more esoteric commodities like fertilizers and polyhalite and things like that, but very little moves into let's say lithium or things like that because the markets are still too small. Are they rushing forward to do investments? The answer is no. And the reason for that is they were burnt in the last super cycle where they overinvested. So at the moment, the investments are still very, very cautious and very measured. So to answer your question is, in part, yes, they are preparing, but in some cases they might be a little bit behind the curve.
Okay, great. Thank you, Grant. So this is, I think, a great opportunity to bring on Will Harris, our senior oil analyst covering the European oil majors. Will, I think you were sitting in on Equinor's Capital Markets Day, I believe, yesterday. Tell us about what you heard, what they're doing both with near-term financial framework and some of their discussion about where they're headed on the clean energy front.
Yeah, thanks, Rob. So it was an interesting capital markets day yesterday from Equinor, and I think the major takeaway is that the company is very clear and determined to accelerate their energy transition strategy. This is mostly supported by a significant ramping of their renewables and low carbon spending. So now the company expects to be spending 50%, so half of total group capex by the end of the decade, by 2030, on these new businesses. And to put this in context, this is far, far above any other European major or any other major that we cover. So for Total and BP and Shell, we're looking at maybe 10% this year. So this is really drawing a line in the sand on their intentions. And of course, with this is coming a sharp growth in renewable power generation. And of course, with Equinor, that they are the offshore player. So this is going to be overwhelmingly weighted to offshore wind, we believe. And I think another interesting point to note here is that Equinor is uniquely positioned with its upstream portfolio. The part of the company's energy transition is clearly leaning heavily on the upstream oil and gas portfolio over the next decade to really fund and finance this transformation into a much more broader based energy company. And then how it has an advantage portfolio in this is that their upstream, predominantly in Norway, is very low cost. It's very low break even, and it's extremely carbon efficient compared to its peers. So these are the kind of assets that will be the most resilient in an environment in which investors are showing increasing concern about emissions profiles. This is the kind of upstream portfolio that will perform well in the near term. In terms of the company's near-term financial framework, we're seeing them deleverage really quickly. They've bumped their dividend again by 3 cents. So they've they've doubled their dividend from their initial cut last year in response to COVID. They've also announced a small buyback for the rest of this year and a step up in that buyback in 2022. And we're really seeing a growth in free cash flow. We're expecting this capital discipline that not just Equinor has shown in response to the crisis last year, but the broader peer group as well. We're expecting this discipline to extend, and with a major focus on driving free cash generation, and of course partly that is going to be deployed into capital distributions.
Will, I'm very curious. I know you've also got a note out looking at investor initiatives, activist investors, looking at some of the resolutions that folks have put out, and I think you concluded that we're seeing increased support for climate-related resolutions, and we saw some pretty stunning outcome with the Exxon board and some changes with Chevron, but frame what's happening in Europe, and I guess the question might be how much of the changes that we're seeing with Equinor, for example, or others, are being driven by investor pressure, or is the management teams themselves quite on board with this?
Yeah, I think that's a really good point. We are seeing much stronger in investor pressure at these AGMs from activist investors. So for Shell and BP, and Equinor actually, they all had investor proposed climate resolutions at their AGMs last month, all by the same climate activist actually, and they were all unsuccessful. They all came below the 50% threshold for adoption. But what's really interesting is that the share of investor support is climbing quickly because these resolutions have been proposed in years prior. So in the case of Shell, the resolution received over 30% of support, and that compares to 14% the previous year. For BP, it received over 20%, comparing to 8% previously. So we're seeing a doubling of investor support for these climate resolutions, and you can be almost certain that these groups are going to be emboldened by these results. And I would be really surprised if we didn't see other resolutions and similar resolutions next year. And I think in the case of Equinor as well, which I think was particularly interesting, there was a lot of climate-driven resolutions, and even some pretty ambitious ones, like proposing that the company immediately cease all oil and gas production activities, or immediately invest in nuclear. So you can see that some of these might be a bit laughable. But I think overall management is looking across the Atlantic at Exxon. That's what's happening at Exxon, and I think they are becoming a lot more responsive to the risks around climate and emissions, and I think this is definitely a part of the driver with the shift in strategies that we've seen in the last few years.
Thank you, Will. I think this is a really good opportunity to bring on our senior utilities analyst, Elchin Mammadov. Elchin, I'm always tickled to hear Will increasingly talk about renewables and electrons and that sort of thing. You also had a capital markets day in the past week for Orsted, which is an early mover in this saga. So tell us about what they're doing. How does it contrast with what you heard Will just tell us about Equinor?
Orsted is a direct competitor to Equinor in offshore wind. Again, the offshore wind is the bread and butter for Orsted. However, the capital markets day has disappointed many investors, and the key reason behind that is although Orsted has increased its ambition in terms of growing its renewable capacity, the new target is to grow it to 50 gigawatts by 2030, and that compares to previous targets of 30 gigawatts. So it's a big step up. And just for perspective, they already have just 12 gigawatts. So that's a big jump for them. They plan to add at least 3 gigawatts every year for the next decade. However, the market was disappointed because of those 50 gigawatts, 30 gigawatts only is offshore wind. So, and 17.5 is onshore wind and solar, where the returns tend to be lower. So the market is taking it as a sign that perhaps the competition is pushing Orsted to, try not to bid over aggressively in some auctions where returns aren't there or the risks are too high because they're fully merchant or whatever, and increase its project pipeline by accelerating its growth in onshore wind and solar, where Orsted doesn't really have that much of a competitive advantage and where the returns are potentially lower. So that was a little bit of a disappointment, but just gets to show that, yes, there is a competition from oil majors. However, what Orsted has said, like literally yesterday, is they don't view oil and gas. They view oil and gas companies just like any other utility competitors. What they're really wanting for governments to do is to accelerate the auctions of seabed tenders, because that's the phase one of how you build the offshore wind farm. You get that, you win the tender, you have the permit in place, and then once you get all the permits, then you can bid at the auction. So unfortunately, Orsted saying Europe and other countries are very slow in doing this kind of tenders. I mean, we've had one in Scotland which was won by oil and gas companies predominantly, but Orsted didn't want to overpay, so Orsted wants more of these tenders so it can get at least some share of it. And the company is targeting about 20% market share in offshore wind. So yeah, it's a mixed bag for the company.
Thanks, Elchin. So one of the topics that really plays into this conversation, whether you're looking at the offshore wind space or just sort of the renewables component writ large, is the role of gas as a bridge fuel. We've talked about it plenty of times on this call, but you actually have a very interesting take that you've been publishing over the past couple of weeks here. You've looked at the idea of a gas OPEC or a gas cartel that could emerge. Tell us about your research and what you're thinking could unfold there.
Yeah, I mean, with a very frequent regularity, we see the speculation about, oh, there's going to be a new gas OPEC because oil is on the way down. In the long term, the demand for gas, at least in the medium term, as a bridge transition fuel, is going to be quite strong. And at the same time, we're having a shift from point-to-point pipelines, where the gas is sold at an indexed to oil prices and sold via 20-year fixed price take or pay contracts, again indexed to oil, to more flexible market where the gas prices are increasingly determined by supply and demand dynamics. The LNG is bigger part of the gas trade and is going to increase over time. So because of all this reduced power of gas producers and increased competition from everywhere, there is increased talk of, oh, let's turn the existing collaboration structure, which is called GECF, Gas Exporting Countries Forum, into some kind of a gas OPEC. And we think it's very unlikely because you'll have competition investigations from Europe and sanctions from the US and whatnot. But more importantly, there are two big players in the gas market that matter apart from the US. It's Russia, which is part of this GCF group, and Qatar, which is second biggest producer in there and exporter. However, we think Qatar is going to we're going to maximize profits by exporting as much gas as we can for whatever price we can get, and we're going to outcompete everyone because we're a low-cost gas producer. And that's, I think, why the gas cartel is unlikely. So for Russia to be able to form that gas cartel, and Russia wants to do that, to have higher gas prices, you need to have Qatar, which is not going to play the game, but you also need US, which is obviously not going to be part of any cartel. So for those reasons, I think this gas cartel is very unlikely. And again, when you look at the track record of OPEC, it hasn't been great. Yeah, in the short term, it may stabilize the prices a little bit, but it gave such a big market share away to the US and other independent gas producers that probably the gas producing countries such as Qatar would not want to do that. And as you know, Qatar has exited OPEC. So yeah, it's an interesting thing. We think it's a non-starter though, gas OPEC.
Thanks, Elton. Very interesting. Will, I want to come back to you. You didn't mention gas very much in some of your previous comments. Obviously, a lot of the integrated oil majors have looked to gas as a bridge fuel, and they have LNG as part of their portfolios. How much of a discussion are they giving to gas at the moment? Where do you see it fitting within the overall strategy?
So as it stands right now, for most of the European majors, gas still represents a central part of their long-term strategies, particularly LNG. For Equinor, much less so on LNG. They only operate one LNG facility in Norway, but they are the second largest gas exporter to Europe through pipe. But yeah, gas certainly still plays a really, really large role in these long-term strategies. The majors all universally cite natural gas demand as being extended for multi-decades, robust, driven by increasing electrification, climate change concerns, pollution concerns. But I think clearly seeing the pace of renewable growth that we're seeing unfold, and again some of the projections we've seen, like the IEA's net zero report that was put out a few weeks ago. I suspect that there might be some concern over some projects, particularly some of these very expensive multi-decade LNG projects that are expected to still be or that are under construction that won't have their first cargo until the late 2020s and are expected to be operating for another 20 plus years after that. I would not be surprised if there's some serious discussions going on about whether these can be made more modular as a way to mitigate potential capital at risk there.
Love the idea. Let's see if we can do LNG on a smaller scale. Sally, this is a great point to bring you on. I think the OPEC member countries, a number of them laughed and criticized quite vocally the IEA net zero report that Will just mentioned. Tell us how the dynamic is playing out right now and how you're seeing OPEC and where you see the balance for the global oil market over the next couple of months.
Sure. Thanks, Rob. In terms of the balance for the market, as you mentioned at the beginning of the call, there's a lot of optimism at the moment about demand. It's the vaccinations, it's the easing of the restrictions, and the substantial drawdown in US stockpiles that we saw, which are all very bullish and really have been pushing oil prices up. And we know Brent today is flirting with $75 a barrel. So I think the biggest this is on the demand side of the equation, and we knew we didn't know the pace, but we knew we would keep getting good positive demand news. On the supply side, though, I think the biggest balancing factor that we were expecting was Iran. The sense that we got in the majority of the last month was that the current round of talks was the last one, a deal was imminent, etc. But now it seems that a deal is not imminent, and we're not going to get that extra Iranian barrels anytime soon. So in terms of the balance, we are looking at demand recovering apparently rather strongly in the near term. And we have the planned OPEC plus easing of the cuts. So we have these extra barrels that OPEC plus is bringing, but we are yet to see how they compare. And there is a scenario in which demand is recovering faster than these planned increases in supply. Iran isn't coming back, so there is this scenario where we get a market that is tighter than we initially thought. And to the with regards to the first part of your question, the IEA report about net zero. Again, when you look at it, it looks like OPEC would be gaining market share, because if there is all this investment that is being halted in the rest of the world, and OPEC being lower cost keeps producing oil, bigger market share sounds good, right? But not quite, because this scenario really sees demand plummeting down by 75% by 2050, and sees oil prices going down all the way to $24 a barrel by 2050. Again, I think this is, you could argue how reasonable this scenario is, but again, this is a scenario. This is one of the many pathways that would take us to net zero, and I think it has got a lot of criticism by the sector for not being realistic. But I think what they were trying to do was to translate what all these policies to try to get us to net zero by 2050 would mean. But in terms of kind of not investing at all in new oil and gas fields, etc., they may sound a bit extreme, and it's probably not going to happen. But I think it was just trying to show what it would take to get to net zero.
Two quick questions for you, Sally, that sort of pivot off of that. So one is, what do you think the risk is in the near term that, whether it's Western oil majors or just sort of the oil patch in general, the broad upstream part of the business is under-investing? I think this is one potential worry that folks have, that the industry's gotten so distracted by all of the net zero stuff that they're not placing enough focus on the upstream side of the business. So curious to hear whether you think investment is sufficient. And then the last piece is there's a lot predicated on demand recovery, and we're continuing to see lots of new information come out about the Delta variant and other aspects of the pandemic. We just can't seem to quite bottle it up yet. So give us your latest tea leaves on the demand side as well.
Sure. I think these are both very good questions. In terms of kind of the underinvestment by oil companies and perhaps the lack of growth focus in the shale patch, I think this is a fair argument, right? I mean, we did see a reduction in capex by most oil majors between 20 to 30% last year. Obviously, this is going to have an impact in the midterm in terms of oil production, because we do have current producing oil fields naturally declining. I think one thing to keep in mind with this is we do have quite a bit of spare capacity at the moment. I mean, the argument is that as demand recovers, we will use up this spare capacity. But then I think what I mentioned was the international oil companies, and we do have some of these NOCs kind of seeing this space for them to step in and grab this market share. I think this extra market share that will be available to them. So we are seeing Saudi Arabia, for example, accelerating its plan to increase its production capacity to 13 million from about 12 million barrels per day at the moment. So I think for that scenario to play out, we would really have to see a very substantial drop in the international oil companies' production, which I doubt we will. And also on the demand side, I think this argument is assuming that we get very, very, very strong demand recovery to the pre-pandemic level and beyond. So, and that brings me to the second part of your question. In terms of demand, again, we do remain a little bit more cautious about demand side of the equation, both in the near term and longer term as well. I think in the near term, yes, we are getting some signs of recovery, especially in the developed countries, especially in the US. But as you rightly mentioned, I mean, we still don't know. I mean, vaccinations are going ahead, pace is encouraging in the US and in Europe, but we really need to think about this as, I mean, globally, right? Until we vaccinate enough people globally, we will always be running the risk of more variants, more mutations of the virus, which perhaps not in the summer, but following summer, it could mean more restrictions once again. I mean, I don't think anybody wants that, but we do need to keep that in mind. So I think in terms of demand, in the very near term, before summer, as expected, we're getting some good signs of recovery for demand. But looking beyond, I think we will have to watch it very closely, and I think it will be an uneven pace of demand recovery globally. And very quickly, I mean, apologies for the very long answer to your question, but obviously we are watching the jet fuel side of the equation as well, which again, we are seeing more transport and kind of these big percentage numbers year over year for flights, but we are still way below pre-pandemic levels. And business travel is something that we talk about a lot, and this is a big part of the jet fuel story. And we still don't know how much of that will be back. And even if it is all of it that will be back, we don't think that's going to happen anytime soon. So I think that's a really good question. I think we will have to watch the demand side of the equation very well, and I don't think we are out of the woods in terms of demand just yet.
Thank you, Salih. For those who are very interested in a deep dive conversation on OPEC, next week on June 22nd, we've got a webinar at 1 p.m. to talk very deep on OPEC, where the future of the group is headed. We're going to be joined by our colleagues in Bloomberg Economics, Bloomberg New Energy Finance, Bloomberg News. We're going to have a big roundtable discussion on that. If you need help finding information on that, shoot Salih a message, shoot me a message. We'll help you get it all sorted. And everything we've talked about today, you can find the research reports by visiting BIGO. Check it out and reach out anytime if you have any questions. We're happy to talk to you. And thanks for your time today. I hope everyone has a great remainder of their week.